So, if you're a business owner, you know this struggle. You need to grow, you need to scale, but there's this one huge hurdle. You need expensive equipment. Whether you're in construction or tech, how do you get the tools you need without totally draining your bank account? Well, that's exactly what we're going to break down right here. You know the feeling, right? You land that huge new contract, or you see this amazing opportunity, and then you look at your current setup and you realize, uh-oh, my machinery just can't handle it. You need something new, something better, something faster to really level up. And then boom, reality hits. That one essential piece of equipment, doesn't matter if it's for building or manufacturing or farming, that thing has a massive price tag. It's the engine that drives your business, for sure, but wow, is it an expensive one. Let's just put a number on it to make it real. A single basic dump truck, you could be looking at around $40,000. For a lot of small and medium-sized businesses, that is a ton of cash to have locked up in just one asset. You know, there's a reason why nearly 8 out of 10 businesses in the US use financing for their equipment. Paying cash feels good, it feels responsible, but it means your working capital, the money you need for payroll, marketing, and all those unexpected curveballs, is suddenly just gone. And that's a huge risk that can leave your business in a really tight spot. So here's our game plan. We're going to start with why you should even consider financing in the first place. Then we'll tackle the big choice, loan versus lease. We'll look at who actually offers this stuff and what it really costs. And finally, we'll give you a playbook for your application, and this is crucial, the red flags you have to avoid. All right, let's start with the big question. Why even do this? Why take on debt for equipment when you could just be patient, save up, and buy it with cash? Well, it turns out financing is actually a pretty smart strategic move, not just a last resort. The number one reason, and this is the big one, is preserving your cash flow. You keep your money available for the day-to-day grind. But beyond that, you can get some serious tax benefits and really flexible payment terms. It also means you can get the latest, most efficient equipment right now, which keeps you ahead of your competition. And at the end of the day, you're building ownership in a real asset that makes your company stronger. Okay, so you're on board with financing. Now you've hit your first big fork in the road. Should you get a loan or should you lease? They might sound kind of the same, but they are fundamentally different. Think of it this way. An equipment loan is all about ownership. You make your payments, and when you're done, that piece of machinery is yours, free and clear. It's perfect for stuff you're going to use for years and years. A lease, on the other hand, is more like a long-term rental. The payments are lower, and when the term is up, you get choices. You can buy it, give it back, or, and this is key, upgrade to the newest model. This is awesome for stuff like computers and tech that gets outdated super fast. Now, this is where it gets really interesting, especially when you compare these options to a traditional bank loan. Just look at the approval rates. Equipment finance companies, they say yes over 80% of the time. Banks, they say no to about 85% of people. That's a huge difference. And the down payment? A bank might demand 20 or even 30% up front. With a loan or lease, you're usually just talking about your first 1 or 2 payments. It just makes it so much more accessible. So we've established that the big banks aren't always your best bet. So where do you go? Who are the main players in this game? Let's break them down. So you've got 3 main options. First, there are the traditional banks. Sure, they'll give you the absolute best rates, but man, they want the perfect borrower. We're talking spotless credit, years in business, the whole 9 yards. Then you have equipment finance companies. These guys are specialists. They get your industry and can offer way more flexible terms. And finally, you've got the online lenders. They are all about one thing, speed. They make it easy and can get you funding sometimes in just 24 hours. Okay, let's get to it. This is the part everybody really wants to know. Let's cut through all the jargon and the sales pitches. What are the real, actual numbers? How much is this going to set me back? Well, the answer to that question really boils down to one simple thing. How risky do you look to the person lending you the money? And the main way they measure that risk? You guessed it, your credit score. You can see right here just how much your credit score matters. If you're rocking a FICO score over 700, you're in the sweet spot. You'll get the best rates, somewhere in that 4 to 11% range. But as that score drops, the lender's risk goes up, and so does your rate, climbing as high as 18%. And for scores under 600, lenders see a lot of risk, which is why those rates can get pretty steep, sometimes even over 45%. Now, I see this all the time, and it's a huge mental trap for business owners. They see these numbers, and their brain immediately jumps to comparing them to a mortgage rate, and that just sets you up with totally unrealistic expectations. It's the wrong way to look at it. Here's a much better way to frame it. An equipment loan isn't as safe as a house, which doesn't move, but it's way more secure than a credit card, since there's a real asset backing it up. The best comparison is actually a regular car loan. When you look at it through that lens, the pricing starts to make a whole lot more sense.
Okay, so we've covered the what and the why. Let's roll up our sleeves and get practical. How does this whole application process actually work? What are the steps to get from point A to point B? The good news is, it's a pretty straightforward path. It all kicks off with you submitting an application. Then, the lender does their credit check to figure out your terms. Once you're pre-approved, you get to do the fun part, go pick out your equipment. After you finish up the paperwork, you get the final approval, the lender pays the seller, and your payment plan kicks in. And then, at the very end of the term, that awesome piece of equipment is all yours.
And that brings us to our last section, and honestly, it might be the most important one. This industry isn't regulated as tightly as, say, home mortgages, and that means there are some real pitfalls and, frankly, some predatory stuff you absolutely have to look out for.
First up is the personal guarantee. And yeah, it is as serious as it sounds. This little clause, which is in most small business loans, says that if your business can't pay the debt, the lender can come after you personally. That means your house, your car, your personal savings, it could all be on the line. You just have to go in knowing that.
Now, let's talk about a really nasty trap. It's called an evergreen clause. Some companies will bury this little nugget deep in the fine print. It says that if you don't give them written notice by a very specific date, your lease automatically renews for another year. So you think you're done paying, but they just keep billing you, sometimes costing you thousands of extra dollars for absolutely nothing.
And here's another huge red flag: the bait and switch online calculator. You've seen them. They advertise these amazing, super low rates. You plug in your numbers, you budget for that payment, you commit to buying the machine, and only then do you get the real contract. And surprise, your actual payment is double what the calculator showed, because it was only showing the rate for a borrower with a perfect 850 credit score. So, at the end of the day, it really comes down to this simple question. Your next equipment purchase, is it going to be an investment that builds your company or a liability that drags you down? When you do it right, financing is an incredible tool for growth, but if you're not aware of the risks, it can become a trap. The goal here is to make sure that equipment is working for you, not the other way around.